As I mentioned, China's yuan is maybe the most important indication, most visible indication of all of these major problems, this instability in China. So I don't think it's an accident that Xi Jinping let it be known in Western media sources that he visited the People's Bank of China as well as the State Administration of Foreign Exchange. China's President Xi Jinping made his first known visit to the nation's central bank since he became president a decade ago, two sources with knowledge of the matter said. As China's economy and financial markets grapple with headwinds, that's putting it kindly. The world's second largest economy grew faster than expected in the third quarter, but there are deeper concerns about continued weakness in the private sector and private sector activity, as well as a lack of long-term reforms needed to shift the economy to consumer-led growth. No, the Chinese have been trying repeatedly to reform the economy. The idea of rebalancing goes back to Hu Jintao, as well as Li Keqiang, his protege. And rebalancing doesn't happen. They have tried, and they've tried reform several times over the last 15 years, really since the 2008 crisis. Again, the permanent rupture in the Chinese economy because of the global economy. The global economy is not the same. The reforms aren't working, and Xi Jinping appears to realize that's the case. Disagree with him all you want, he's at least acting out of rational sense of where things actually stand. Not this strong economy, China turned a corner in 2023 nonsense. One of China's biggest dangers, of course, is its real estate situation. That's reflected in the weak currencies. It's reflected in the weak economic fundamentals, not strong fundamentals, weak economic fundamentals. As I talked about in the recent video, retail sales in particular continue to struggle enormously because the property sector is not turning a corner in either direction. It continues on in the same way as it had over the last couple years. Just this past week, Country Garden, a name that has become very familiar to not just Chinese audiences, but also Western audiences, they actually officially defaulted on a Eurodollar bond. In fact, that default was declared by the Credits Derivative Determinations Committee in a credit default swap payout event. That was on, the failure to pay happened on October 18th, and the determination of default happened just last week. And as Bloomberg just said recently, Country Garden's dollar notes are indicated at just 4 cents, according to prices compiled by Bloomberg, reflecting how little investors expect to recover. Some of the bonds were near 80 cents in June when all of this stuff really got started. China turned a corner during the summer, politically, economically, currency, financially, fundamentally, and it doesn't look like it's coming back. So just in terms of the currency and the Eurodollar system, that's a huge amount of instability for the system to deal with, because Country Garden is not just about Country Garden. It's emblematic of the entire way of how things were working or not working over the last several years as they related to China, but also the big picture sense of post-2008 reality. In terms of China's currency, authorities continue to try to steer it in the stronger direction. The midpoint parity or the central parity, they continue to move it down day after day after day, a few pips at a time, a few pips here and there. As of today, the fix was 717.79. Again, that's continuing to move in the stronger direction. At the same time, the market value of the currency, that doesn't move much at all. If anything, it looks as if the authorities are intervening more directly and more actively in the currency markets, where they're looking at establishing a floor right around 731.70 or so. And you can see it clearly on the intraday chart, where every time the currency gets close to 731.70, 731.80, it seems to just lose all sorts of trade, all sense of trading, and all sort of volatility. It just goes flat here, which is a telltale sign of interventions. We also have data on interventions because we know from SAFE itself, the place that the Xi Jinping just visited, foreign reserves in China have been dropping rather precipitously in August and September. Now, some of that is the market value of the reserve assets that they hold, including U.S. Treasuries that are going down in value. But at $45 billion in September and $44 billion in August, that's the biggest 2-month decline in reserves since April of 2022. It's starting to look a lot like 2015, as I've mentioned before. And it's not just China's foreign exchange. From their perspective, we also see it from the U.S. perspective. According to the TIC data, or Treasury International Capital, that is provided by the U.S. Treasury Department, China's holdings of U.S. Treasuries continue to decline at a relatively quick and precipitous rate. Mainland China's holdings of U.S. Treasuries fell to $805.4 billion in August. That's down from $868.9 billion in April. And just to be clear, because you hear this all the time, especially on the internet, governments don't sell their treasuries because they hate Biden, or they hate America, or they hate the dollar, or they hate U.S. Treasuries, or they hate Jay Powell, or they hate rate hikes. They sell their treasuries to try to stabilize their currency because they're being faced with a euro-dollar funding shortfall. You sell your reserve assets to supply those reserves, now cash, into the local marketplace. So as China's treasuries go down, that's another sign that China is actively and heavily intervening to try to keep CNY stable. And the reason that's important is if CNY was legitimately stable, it wouldn't require massive amounts of intervention to try to keep it around 731.70 and not have a whole lot of success doing so. It continues to move lower and lower a little bit at a time.